Welcome to Dividend Talk, episode 125, an interview with Life with Dividends. Hey guys, it's time to inspire you again with a story from our fellow blogger and one of our community members, Life with Dividends. We can promise you it will be quite insightful to hear his American perspective. Guys, let's get started and see you on the inside.
Yo, European DJI. How are you, buddy?
I'm doing fine. It's so good to see you again after a week of hard working. How are you doing yourself?
I'm good. We're back on a Friday night, and we are joined this week with Life with Dividends. Kind of excited about this one. Life with Dividends. How are you?
I'm doing good, EMF, and thank you for having me on the show, EMF EDGI. Pleasure talking to both of you.
It's it's our pleasure to have you here, and maybe just for some of our listeners, if you just give us a brief overview of who you are and maybe a little bit about your blog and so on.
Sure. So I am by day a low-level software engineer working for one of the huge big tech companies here in the US. I work primarily in the semiconductor industry. I'm in my mid to late 30s, hail from Texas in the USA. But as you can tell from my accent, my roots are Indian in nature. So I hail from that part of the world. And in my spare time, I blog on dividend growth investing, value investing, and in general, anything that touches investing, retirement, or personal finance. This is something that I got started with kind of around 2020-ish timeframe and has since, been a big passion of mine.
Yeah, and that's also why we want to have you on the show, because I think you're maybe a little bit known on social media, but I've been following your blog, I think, from the first article, if I remember correctly, and you have really some golden nuggets in there. So even if people don't know you yet, even before we had this whole show, I would already recommend just to look you up. And you're also actually really sharing your income updates and everything, right? Because I know that some people are really always inspired by that. So also for that, they can really read there. But maybe more about that later in the show. Derek, tell me, what's the news of the week?
The big one recently came out. I don't know if it was today or yesterday. It was about Blackstone, a company I have in my portfolio, but they are limiting withdrawals on their unlisted real estate income trust. So look, I don't know the full details. It only popped up on the news, but it certainly does not seem like it's good news when you have a huge asset management company like this limiting investors what they can withdraw from their investments. I know it's surrounding the real estate business, and I believe they're overinflating the value of some of their real estate investments, which is causing people wanting to withdraw more, and they're putting a stop to that. So it doesn't seem really good on the face of it.
What do you think? Is this really the beginning of a black swan?
I don't know if this is the beginning of it, but it's certainly it's not good. Look, it's one company. If we start to see other asset management companies, BlackRock, we did see some news about BlackRock recently as well. So maybe we're starting to see it, but usually institutional investors are ahead of the curve, aren't they? And if they want to start taking money out, usually it's a good sign to get out of the way. So it could be something bigger here.
Nice. Well, I my opinion. I hope so. Sometimes we get some criticism from some listeners that email us. Then, like, yeah, it's nice when you're in an accumulation phase, but when you're living off dividends, well, when you're living off dividends, of course, it's a little bit different. But if you have a safe dividend portfolio, it should be fine, right? But for me, it can't crash hard enough right now, as long as they don't fire me at my job.
Exactly. And look, we're dividend growth investors. You're right. We invest in dividends, not the price. So if the price is crashing, you should be okay. We're just in the accumulation phase, so we need that price a little bit lower. So just keep going, keep crashing, and we'll be happy.
Good, good, good.
So usually we do a rapid fire round, life with dividends. I don't know if I spoke to you about this before the show, but we're just going to ask you 5 questions, easy questions. There are 2 answers, and you'll just have to say straight away which one you pick, and you can clarify 1 or 2 of your answers afterwards. Does that sound okay?
Yeah, let's do this.
Okay, so I will start. Taiwan Semiconductor or Texas Instruments?
Oh, that's easy. TXN, Texas.
Cool. Machine language or assembly language?
Assembly language.
Football or soccer?
Football. I know I'm from the
Football.
States here, but it is football.
Cool. I agree with you. High dividend yield with low dividend growth or low dividend yield with high dividend growth?
Low dividend, high growth.
And then for us nerds out here, Moore's law or Wirth's law?
Ooh. I'll have to go with Moore's law maybe on this one, but it's a contentious topic. On some other day I would pick Wirth's law as well.
Cool. I should have asked you on another day then.
Yeah.
So do
maybe
you
maybe
want
I'm
to
the
talk through?
stupid one in the room here, but what is Wirth's law? I mean, you can't leave me in the blind here.
Derek, you want to go for it?
Yeah, Wirth's law is saying that computer software is slowing down faster than the hardware is getting faster, if that makes sense. So we're not kind of keeping up. Well, our hardware is not quick enough. It's going to keep slowing down quicker than what we can progress.
Yeah, my computer is quickly getting slower, if that's what you mean. Or the opposite.
Yeah.
Oh.
So do you want me to go expand on some of those in terms of my answers to your rapid fire questions?
Yeah, probably around, you said it's an easy one with Texas Instruments. Maybe a little bit of why that was so easy for you.
Well, but it's mostly from a standpoint of what I directly interface with. TSM is more on the fabrication side, and generally when the wafers get laid out and when you finally get your silicon back, whereas TXN is something, TI or TXN, their chips are something that I work day in and day out. And so from a familiarity standpoint and being in my circle of competence, if you will, I would pick TXN because their business model is something that I understand a lot more readily than maybe, let's say, TSM's, which is a little more complicated, a little out of my area of expertise. And so it's mostly from that standpoint.
Awesome.
I would
invest in
choose
what
the
you know.
same.
Yeah, invest in what you know. That's what they say.
Correct.
Awesome. So you mentioned, we might as well just get straight into it. You mentioned that you've been investing, I think, since 2020. So I'd like to maybe understand how you started. How did you discover investing around that time? Was it the COVID crash? Was it around that time? What got you into investing?
Well, so I actually started investing way back in 2012. So bit of a background, given the kind of upbringing that I come from, my roots being Indian, we are generally averse to stock market investing in our part of the world. And we generally, at least I think this is typical with most South Asian families. We are taught to save a lot more. So we have the saving mindset, generally a frugal lifestyle, and anything that has got to do with stock markets or investing in general is akin to gambling. And I came up with that mindset, but it changed when I was inducted into the workforce here in the States after my education. And for no, real choice of my own, when I started investing in my employer-sponsored 401k and then their stock options, I kind of got myself into index fund investing. And as I speak, even now, most of my net worth is tied with index funds and index fund investing and ETFs, through the retirement accounts. But as I kept learning about it, I very soon changed my mindset. I said, look, investing, the markets aren't quite rigged. This isn't gambling if you know what you're doing, and there is money to be made here. It's just a question of educating yourselves and kind of changing your mindset. And that's the message that I largely provide to most of my readers and to your listeners too, in the sense that this isn't a rigged game. This is something that you can be good at, even if you don't necessarily have the right background for it from the get-go.
Yeah. The cultural difference there is quite interesting to me. It's something that I didn't know. But do you think that is changing over time? You know, the world is getting smaller. The internet is bringing everybody a lot closer and lots more information. Do you think that culture is starting to change over in that part?
For sure. I think the advent of YouTube and podcasts like yours, which have a global outreach, will certainly help, because now this information that was previously only contained within, let's say, the US or the Europe, is now more broad spread, more widespread. People are on social media, on Twitter. They have access to the same podcasts, the same YouTube channels, the same set of investors. And there are idols to look up to, right? Monish Pabrai from India, there's Prem Vatsa, there are other great investors from our part of the world. Even Li Liu, who manages funds for Charlie Munger, is from the China background. So all that helps, and maybe things will change or are changing from that standpoint.
And do you also talk about it with your family and such back home, let's say? And
yes, because I can then show them something tangible, in the sense that, look, here's what I've done, and this is not made up numbers that I've picked from somewhere, or I'm speaking from my ass or something. These are real numbers. This is my salary, and this is what I've invested, and this is how I made. And so if all of that is public knowledge, and that's kind of the motivation behind the monthly income updates as well.
Yeah.
If I am investing X amount of dollars and I'm making this much in monthly income, and I'm pretty straightforward and transparent about that month in and month out, it should serve as motivation for anybody to do that. And it's not that far-fetched. It's achievable.
Yeah. Yeah, I find myself that with my family, I can't talk about this stuff. They are not even open to it. They are so locked into, like, you need to have a house to build wealth, and then you have something for later, and the rest is on the savings account. So, I mean, I tried, but if people are not even open to it, it's kind of senseless even to talk. And at a certain moment, if you start repeating yourself, you just annoy people as well, right? So, if you have any tips, let me know.
Absolutely.
I think that's where the blog comes in handy, and detailing. I know you're both anonymous, but detailing your amounts is kind of inspiring to people. And maybe when you're talking to them at a party full of alcohol, they don't want to listen, but they will sneak at your portfolio every now and again and go, "Wow, he's earning 300, 400 a month from this. Maybe I can do this." So
I will tell you what happens really in reality. In 4 or 5 years, when I say that I'm early retired, they will say that I'm a fraud, that I cheated the system, that I probably are trafficking drugs or something like that. They will just not believe it. They will just not believe it, and they don't trust it. I'm sure. I'm 100% sure.
We'll see. We'll see. I have a different experience over here. My family are now getting involved. My brother started Dividend growth investing. He actually owns more shares of Johnson & Johnson than I do. It's his first purchase. He bought more than I. So it's Look, I think it's awesome, but I think the blog was a huge part of that, and detailing
Mm.
the amounts, because it's as you said, life within dividends. It's tangible. It's easy for them to see and understand, and not just me blowing smoke up my own. Do you know what I mean? It's there. It's all out in the open. So I'm similar to you. I just want to inspire people to show them that you don't need to have a lot of money to start this game. Anyone can get involved. So I'm happy to see you with your blog, Life of Dividends, to show month by month what you're earning, and even just to see, I think your November update, it was nearly 100% increase in dividend year on year from this time last year, if I'm right.
That's right. That's right. And this is a month where I did not have a chance to even look at my portfolio, and I was, busy tending to family and having health issues and all that. That's the key, right? I can rely on a portfolio that's mostly autopilot and doing stuff while I tend to other things. And this point can't get emphasized enough, because that's a huge advantage with dividend growth investing, that I think none of the other investing strategies give you that flexibility.
Well,
So
effectively, you have like million people working for you around the clock. Yeah. And they're giving you more money every year. I mean,
Yeah, yes. It's an interesting way to look at it, but it is true.
yeah.
So you've been investing since 2012, you say. At what point did you shift into dividend growth investing, and why?
So it was mostly a standpoint of going through a life event where I realized that, I needed some means of generating a passive income to supplement my real income. We are in an economic environment here where layoffs are, happening as we speak here in the States. I don't know if it's the same on the other side of the pond in Europe, but I went through such a cycle around about the 2016, 2017 timeframe, and it's quite disruptive as far as your family life, because a lot of things are tied to your paycheck. Here in the States, your medical insurance and all of that is also employer sponsored. So it was a huge deal for me. Um, and I made it a resolve that I didn't want to put my family and myself through something like that again. And so what were the ways in which I could truly generate passive income without really, spending more of my mental bandwidth in my cycles from my regular day job? And in my research, so thus far, I've yet to come across something that's as passive as dividend growth investing. I don't know if you guys agree or disagree, but it's the true form of passive income. And I've seen time and again with several examples where, I can let go of my portfolio, not look at it for weeks on, and it still somehow auto manages itself with drip and all that and takes care of itself. And that's where I thought, this is the way to go. This is the compounding also helps. Invariably, it tends you towards the right investing strategy of like buy and hold, because dividend growth investing is buy and hold by definition if you want to realize the compounding at a future point in time. I also believe dividend growth investing is, in some sense, dividend growth investors are closet value investors as well, because you kind of look at value investing, invariably while looking at the dividend yield and analyzing companies. So there's a lot to like. There's a lot of check boxes that it checks for you as a strategy that none of the other strategies, meet those criteria.
Yeah, you bring up a good point also about passive income, because sometimes people think actually that blogging or other side hustles like setting up a training course is also passive income. And I don't see this passive income because you need to maintain it and such. There's still blood, sweat, and tears needed, but probably it's little effort income. Yeah, you could also say, of course, dividend investing. You need to do at least some I said some time investment in picking the right stocks or ETFs. But generally speaking, you cannot touch it for years. And if you have done your right analysis, your income will not even grow over time as well, right? It's just like how much time you want to invest in it. It's a choice at this moment in time.
That's right. I mean, the way I look at it is this is mostly a one-time huge effort on your end when you're picking your businesses for the
Yeah.
very first time. And then from that point on, it's mostly incremental, unless there is a huge catastrophe that has happened with your investment, like let's say with 3M, for example, the
Yeah.
litigation and all that, where you have to go back and now seriously introspect what's going on. But usually those are rare.
Yeah.
And they don't happen that often, at least not with every business every single time. But with
Yeah.
other streams of income, like YouTube or blogging,
Yeah.
those are not really passive. Yes, they are passive in the sense that they might not be your main hustle, but you still
Yeah.
need that investment from your end. So it
Yeah.
kind of defeats the purpose that way, right?
I think there's one passive income that's similar, and that's called marriage. You also need to invest a little bit to set it up, and then you find one that earns money, and then if they are also working hard in their career, it keeps on growing every year, and from time to time you need to check in how it's going, right?
Great suggestion, EDGI. I hope some of our younger listeners will pick up on that. Unfortunately,
Yeah.
I and you guys are kind of already, set in our paths, if you will, as far
Yeah,
as.
but I get a lot of passive income from the other half, so I'm good.
That's good. That's good. Uh,
Yeah, so I mean, I tend to agree with you a little bit. It is passive income in a sense, but you're right. There is some blood, sweat, and tears that you need to do up front to pick whatever. I don't know. I'm looking at your portfolio. There must be maybe what 20, 30 companies, and then there's some ETFs. So there is a bit of work involved in that. So what does that look like for you? How do you narrow down what companies you want to have in your portfolio?
So it's a very involved process in the sense I spend upfront enough amount of time filtering out, and this is kind of one of my investment learnings in the sense the key to picking businesses is knowing what to ignore. And you generally start off by saying no to a lot of companies. And when you do that, and you're pretty strict about your screener criteria, you end up with a handful of basket full of stocks that you can then go about and start looking at as far as fundamentals. And we can get into all kinds of metrics with respect to fundamentals. You guys did a pretty good job of entry-level fundamentals in your last episode, but that's a good starting point, right? You obviously also look at, we are dividend growth investors, so I look at dividend history, I look at the starting yield, I look at the dividend growth track record and potential future dividend growth as well. I also look at how does this fit into my overall portfolio as far as diversification, and whether I'm overextended in certain sector or not overextended in certain sector. And I also, something that doesn't get looked at as much, but I've since started to look at now, is the overall quality of the management, because I are of the firm belief that if you can't quite piece together a good management team, regardless of the quality of the business, you are setting yourself up for failure as an investor in the long run. And we've seen enough examples of this in our recent past, right? We've seen Intel with Bob Swan, Unilever with Alan Yopi, or on the
Castellum.
Europe side. Castellum has
Yeah.
come up as well. Microsoft, if you look at the Balmer era versus Satya Nadella, there are enough such examples, right? All fantastic companies, but in the wrong hands can lead to a very poor investment, and can be a huge setback to a dividend growth investor who relies on something like this for 10, 20 years down the line in terms of compounding, that can be a serious drawback. So I don't know. I mean, these are kind of entry-level screener criteria in my mind as far as looking at potential businesses to include.
Yeah, that makes totally sense. And I said, are there also, for instance, when you think about beyond the entry criteria, are there certain things that you've learned that you really need to look at? Because you mentioned management already, and we can also even talk about our favorite IBM here. By the way, of Indian roots.
Indian roots.
But are there things like, if you look at the 3 financial statements, are you also going to that level when you're analyzing things?
Yes,
and
I
I
do.
mean, with that, the next step, right? When we do the fundamental analysis, I get.
Yes, you talked about different metrics in your last episode with ROIC, and compare that with the weighted average cost of capital, WACC. I look at cash flows primarily, and anyway, I have to do that with the valuation as well in terms of coming up with a good fair value. So I generally look at the existing cash flows for the past 5 to 10 years, look at the debt profile that this company has over the last 5 to 10 years, look at what are their main revenue growth drivers, especially if a business is having multiple segments, multiple arms, which are the ones that are kind of flattish and which are the ones that are kind of growing and have potential to grow. And each of these can give you useful insights. Johnson & Johnson was one where even before they're split up, if you actually looked at their revenue breakdown, you could see that consumer goods, as far as Johnson & Johnson, although they are famous for that portion of their business segment was mostly flat. And it was really the medical side, which is medical devices, and pharma was the one that was really growing or contributing towards the growth. So the fact that they spun it off into a separate segment did not surprise me one bit, because they were trying to streamline and be a little more efficient in running their shop. But if you do that research up front, some of these moves don't necessarily surprise you, and you're prepared for it, and you're kind of set up yourselves for that eventuality.
Yeah. And how did you acquire the knowledge about this? Because that's a question we get a lot.
So unfortunately, most of my learnings, like most of my generation, started off with reading blogs and looking at YouTube. And I say unfortunately is because I think a number of your guests have also made the same point. Tiago, I remember when he was on your show, made that point that if you start off wrong in terms of the people you follow, you can be led astray to believing some things that you're not really supposed to believe in. And unfortunately, I started out that way. And one of the good skills and biggest learnings that I've had is having a good BS detector in me. And as an engineer, that's pretty useful as well, because I kind of rely on numbers. But the value of a good BS detector helps me there, because when I see the BS red light lighting up at the corner of my brain, I know very well that I should stop what I'm doing and look at someplace else. So thus far, I've been looking at books mostly, and I've been very selective about reading blogs where I can get the maximum amount of value from them. EDGI, your resource, your blog resource, and your YouTube is pretty nice in that it's mostly cut out all the BS, focus on the numbers. Here's what my valuation looks like. Here's what cash flows look like, and this is what it is. And Jan Lopuk has also been pretty useful on the YouTube space. Is one of the few golden gems out there.
Definitely.
Ashwath Damodaran, Professor Ashwath Damodaran, has been very, very good. He's a valuation king, if you will, because he talks purely numbers, and there's no BS or there's no hyperbole around it. So
Yeah.
it's useful from that standpoint to kind of look at this in analytical standpoint and draw tangible results for what
Yeah.
you can do in terms of analyzing businesses, right?
Yeah, I think we have these popular American YouTubers like Meet Kevin and such, right? And there's just no meat behind it. It is just fluffy on the surface. Tesla to I don't know how many thousands because they build a great car. Yeah, and I think I hope also with the recent washout of people that at least people took those learnings and actually and started really thinking like, okay, but how does this really work, right? How do you really and for me, to what you say, also just Buffett. I mean, Buffett doesn't necessarily teach us how to calculate, but he teaches us how to think. Yeah, and I really love that about that guy, and I think this is also what I wish we should see a little bit more on YouTube. If you look also lately on the thumbnails, I was looking as well because I make some YouTube videos, so you're also looking at thumbnails. But then when I see people making thumbnails, I think like, oh my god! But I've been also testing with it. If I put an attention mark in it, I get more clicks uh, based on the thumbnail than without an attention mark, which is crazy. Yeah, it just shows the human psychology of what people want, not necessarily what they need.
I completely agree, and that's an unfortunate downside of this YouTube algorithm,
Yes.
because you do have very valuable content creators out there who don't get their attention, and instead it's this nonsense that gets all the views and all this, right? With Meet Kevin and his books. I'd much rather not meet Kevin than meet Kevin.
Yes, exactly.
But I think that people want to be told what they want to hear, and they already have a preconceived idea of the latest trends that they're reading about in the news. So they want someone to say, buy Tesla, because they're already thinking about saying it, so they just want someone to say it. And it's probably one of the reasons that hold us back is that we're, I wouldn't say negative, but as you quite rightly say, we don't follow the trends as much as we could. We would definitely grow quicker if we did, but I mean, both of us are the same. We just try and say it as it is, to the detriment of our followers, if that's the case. But I find a lot of YouTube is they're just saying stuff that they know you already want to hear, and that's what I don't like. And it's a big learning for me was thinking for myself. Not listen. So obviously you watch the guys because they do have some nuggets in there. They are knowledgeable guys. That's why they have channels and they do know what they're talking about. But thinking for yourself, I think, is the biggest skill you can have as an investor.
I would agree.
I think we can quit the whole podcast series now, Derek. That's like now just today. This was episode, what is it, 125? Let's call it a day. I think this is it. No content needed anymore.
Job done. Job done. Life with dividends. I've noticed in your portfolio there is no European stocks, and you listen to a European podcast. Tell me, why do you not have European stocks?
Am I brave or what to come on a Dividend Talk, which is a European podcast, and have no European stocks and talk about stuff? No, it's so there is a bit of home bias, if you will, where I'm in the States and therefore I rely on businesses that are in and around the States. I know some of them invest in Canada and Mexico, but really it's the States, right? But there's also part of my brain that kind of wants to have a tap on what the pulse of the industry is around here, which means I can go and look at businesses, or I can go and look at or go and talk to employees that are working in some businesses, and kind of get a sense for what is going on. And when I invest in businesses that are over on the other side of the pond, I'm mostly relying on news and media, and that's mostly secondhand knowledge, mostly short-term focused, and they don't quite give me a sense as to what's going on really on the ground. Having said that, though, I've been toying with ASML as an investment, as an engineer in the semiconductor industry. It's come up so many times, and I've just not, pulled the trigger. There are a couple of other names, Mondelez International, that's come up in your podcast a couple of times, I believe, in the past, as a Siemens as well, another high quality business that's been around forever. And yeah, it's mostly getting over the hump of my own bias, if you will, and looking at at great investments on the other side of the pond. It is something that's in my radar. Let me put it that way.
And it's this is what I actually learned from Ian Lopok. He always actually spoke about in his videos, like, you don't need to go international to have international diversification. If you take P&G and a Texas Instruments, they earn so much money from abroad. So actually, you don't even need to go and also get the tax hurdles on top of it and such, because you have enough quality businesses in America to that suits the needs of your portfolio. Probably for us it's a little bit different. If you would only go for European first, we have probably on average subpar performance, and secondly, there's just less innovation and less, let's say, businesses that are really set up to drive our future in Europe. So we are naturally looking a lot also at the United States, but it brings us the issue. For instance, I've got Omega Healthcare. I've never been to those last mile death houses in America. Yeah, but they're paying one of the largest parts of my dividends. So, I mean, I the only thing I think, like, okay, if this is their last mile, then, at least I take some money from it. Yeah.
Yeah, I mean, that's a fair criticism, right? I mean, most of these companies that I own also have international presence, so maybe I'm getting it for free, but I don't have a pure play European stock. And it's not that I don't like those businesses. There are so many great businesses over on the other side of the pond. It's just that I have to fight a bias within myself.
Mm-hmm. Yeah, and we have that with Asian stocks, I think, Derek. Yeah, it's also for us just like the mental span that you need to think about those markets and try to understand the context, right?
Yeah. I've similar thinking along the lines with Scandinavian companies. I know it's a little bit closer to home, but it's still all second. I can kind of resonate with what you're saying, like for dividends. For me, I kind of stay away from them because I feel like I can't get a real sense of what's happening because I'm not that close to them. And you're relying on secondhand websites and Google Translate and all this kind of tools just to try and understand. So I get it. If I was living in the US, I probably would have no European stocks. I'll be honest. I would stick to US companies.
No, don't say that. Don't say that. You have several European listeners, and anyway, I'm just kidding.
So tell us then, what are some of your favorite dividend growth companies?
Sure. As far as we have already mentioned TXN, and I know both of you guys brought it up on the podcast before. If you look at their investor relations page, and they have a statement that says something like, "Oh, we define the quality of a business from the free cash flow that it generates." What more do you need? It's like, dividend growth investor porn right there, right? If you start defining things that way, it makes life so much more easier for me to go analyze your financial statements, because everything is in terms of free cash flow, and there's no bullshitting around there. So you can't manipulate those numbers, mostly, unless you're IBM. But yeah, so there's that. TXN is one of my favorites. It's one of my core stocks. So a quick note, I follow a tiered strategy, kind of maybe like BDGI, if you will. I too have core stocks, or in Yen Lopak's words, ride or die stocks. TXN is one of them. I have J&J, PG, Pepsi, and all these other guys, which are really the bedrock, sleep well at night stocks. TXN is one of my favorites. The other one that I really enjoy as a business model is Costco. And it's not something that I think has come up all that often in your podcast. But Costco, from a business standpoint, I feel is a very misunderstood business, because people look at the overall net margins, they see a number that's in the 1%, 2% range, and just toss away the stock. Its dividend growth is also pretty poor. It's in 0.1 or whatever, right? It's in the below 1% range. But if you look at the way their business model is set up, the wholesale business with a focus on membership and growing their membership and the stickiness of their membership, from a pure revenue generation standpoint, on a per square footage basis for their wholesale, they beat Walmart, Target, or any one of these big box retailers day in and day out. And fantastic business. Charlie Munger can talk about this business. He's on their board. He talks about this business in every single interview of his. Nick Sleep, who's a European investor over in England, UK, has written a very nice surmise of why he thinks Costco and Costco-like businesses are such an interesting investment opportunity from an ROIC perspective, in the upper 20% plus range for decades in. So that's another of my favorite stocks. I think it's something that's going to. I'm very bullish on the business, and I hope that they can grow elsewhere internationally as well, outside of the US. And another one that doesn't get talked about a whole lot is United Healthcare, which has been a champion dividend growth stock for me and my portfolio. Again, like Costco, never trades at a low PE multiple, generally always overvalued, very hard to buy. But from a perspective of hijacking what is essentially a broken medical insurance industry here in the US, United Healthcare is one of the top dividend stocks that you can own. And from a returns perspective, again, very, very attractive. So 3 stocks there that I can think of readily.
Yeah, I've been looking at United Healthcare so often in the past, and there was an opportunity and I missed out on it. And I still regret not having bought them like 5-6 years ago when I was looking at it. I always had this feeling like it felt already like expensive, but I thought like, okay, it's high quality. It dipped at the time. But then I thought like, okay, I only hear Americans complaining about their healthcare and how much it costs for them. So I thought like, how much can they still, grow this? But they continue to surprise me. Like I guess people in America have no other choice, right, than to step in and just pay whatever they charge. So it's really a great business model from that point of view.
That's right. I mean, in terms of the options that you have available purely from a coverage perspective, as to which doctors are within your network and all that, there's a monopoly here, or there's duopoly or whatever, right? There are a few insurance companies that kind of are at the rule the roost here, and you really don't have a choice as far as a consumer to pick and choose.
Yeah, from that point of view, monopolies are great as long as regulators stay away. Yeah, because for me, it's always thinking like when you select a business, I always try to think about like, could this be a monopoly? Yeah, without making the the regulator's angry, because that means they have a moat, they have a lock-in. There's kind of this often a network effect and such. So yeah, nice one, nice choices. So you have also a really nice article about learnings and such, and I think you wrote it a few months ago, some of your reflections and such. I don't remember as well if it was also about when to sell a stock and such, but could you share some of those best learnings that you have based on your experience?
Sure. One of these I already told you, which is knowing what to ignore,
Yeah.
having a good BS detector. I am also, you brought up Buffett, and I'm more in the Charlie Munger school of investing, where I don't necessarily subscribe to the original Ben Graham's cigarette butt style of investing, of value investing, but more along the lines of owning wonderful businesses, even though they might not necessarily be at their optimal value. Try and focus more on the quality of the business rather than the perfect value at which to buy them. And that's one. And from a standpoint of when to sell, I am more in the camp of the Phil Fisher school of owning stocks forever and never ever selling them. And this is kind of an intersection between Phil Fisher and Charlie Munger. One of their viewpoints is that you should not unintentionally inhibit compounding when you have an opportunity to do so, right? You should let the compounding go. And if you sell out of a position thinking that it's overvalued, letting your value investor fundamentals kick in, you unfortunately go kill the compounding right then and there, and you don't get to realize your true yield on your yield on cost, right? So try and never ever sell, and if you are selling, make it a decision, kind of like what Howard Marks would say, as a decision to unbuy rather than to really sell. And what that means is, do you have reasons where something has changed fundamentally from your original analysis, such that your investment thesis no longer holds good? Or have you lost trust in your management? I'm looking at AT&T here as a very good example. I can't trust your favorite EDGI, Mr. Stinky. Cannot trust anything that comes out of his mouth. And if you have a situation like that, it doesn't even matter what the starting yield is, or what AT&T is doing, or what they say. How can you rely on anything from the management, right? And that's something that I hold very highly in terms of my other learnings and then decision to sell. That's mostly it.
You bring up a good point, because I have, over the last 2 years, people see that Microsoft in my portfolio is one of my biggest positions, and I got so often the question like, why don't you sell it? It's a low yielder, and replace it for a higher yielder. You will boost your income. But for me, it is, to your point, it's like, let your winners run. Because the compounding effect is way more important. And what I also learned is, like, I have a little part of my portfolio which is a non-dividend growth companies, and here I'm making the mistake that I'm not selling them according to my thesis, because it was never the goal to keep them forever. So I still need to make some shifts here, and sometimes I'm thinking to exclude this 10% out of my portfolio, because it's not doing me well anyway. So maybe I just stick to what I've developed over the years. Good.
Gotcha.
Nice. I think we might leave it there and move on to some listener questions, unless you have anything else to ask. No. Okay. So we'll start with Rafi's question. He said, off topic, but maybe it's fun to answer. If you get the chance to attend the FIFA World Cup final and your home nation is playing in a match, but the trip, for everything included, would cost 6 months of your savings towards financial freedom, would you go?
Oh my gosh. No, I don't like a football match as much that I can, um, you know, put 6 months of my savings on the line for that. It's too much of an ask.
I would be on that plane and I would be straight over if that was urgent. For they haven't got to a World Cup in about 40 years. So yes, I would 100% spend 6 months of my savings to see Ireland play the World Cup.
What about you, EGI?
I was thinking about that. 6 months is a lot, but let's say like that. Netherlands was 3 times in the final and they lost. And I would only step into the plane if I have guarantees that they will win. Yeah, because imagine sitting in the plane back this whole trip and thinking, I just like squandered 6 months of savings on these idiots. Because that's what the real thinking is then, right?
No, because the Netherlands go to this to win. The Irish are just happy to be at a World
Yeah,
Cup. It's completely
1974,
different.
1978, and what is it, 2010? We all lost. We went to win. Ah,
Great question. Tim has asked us, the saying goes, invest in what you know, but it is hard to know about all sectors. Out of all the 11 sectors, how many would you say is needed for enough portfolio diversity? 20 stocks or so.
Hmm, that's an interesting question. I wouldn't necessarily look at it from a standpoint of, oh, since I need to diversify, I need to go own a stock in a sector that I have absolutely no idea and no interest in. Or I would still stick with the old adage of, okay, I want to go invest and I want to try and diversify as much as possible. But if I have no interest, let's say in banks or financials, because I don't necessarily understand them or I don't like them, then why invest in them, right? Um, yeah, I think I'm more in the camp of yes, diversify, but still stay within your circle of competence. And yes, you might have situations where something is a little out of your area of expertise, but if it's still something that you can learn and reason about to a certain extent, then go for it.
so what I've learned in general, right, is that diversification is indeed not so much on the sector, but more on the catalysts that are driving a certain business and the trends that are driving a certain business. So if you're really, for instance, having a lot of businesses that depend on discretionary spending, think about, for instance, the person that goes in the morning to Starbucks, then goes to the Zara to buy some clothes, these kinds of consumers. You don't want to have a large part of your portfolio all kind of targeted to that persona, right? So, and because what you see is that when there is a crisis, there's usually a blast zone, and we had it in 2008 around real estate and banking. If you had a lot of your businesses, for instance, depending on how you say it, real estate or bankers' income, even, yeah, then you are really screwed. So I think what is more important that you have companies that are not in each other's line of business, having kind of targeting the same consumer. I think that's way more important that you can untangle that and have them a little bit on their own islands here to grow. And we see that this year really with energy stocks, right? The tech stocks are getting slaughtered because of I don't know, zero interest and inflation, and then energy bumps up, right? Because there's more like an inverted, I don't know how you say it, correlation. And I think that's more important to look at. And then you can still have a concentration from a sector point of view.
Yeah, but if you really want to diversify across all sectors, if you know what I mean, if that's what you feel you need, then you have ETFs. ETFs are perfect for that. You don't need to know everything about all sectors. I think what the two guys have said, I agree with everything. And ETFs are there if you need to diversify across all of them. Nuno has asked us, any thoughts on, I don't know how to pronounce this, but it's GIMB, the ticker symbol GIMB.
So I just quickly looked it up, right? And I believe it's a private Belgian European investment company, so an equity firm, and it's listed in on the Euronext in Brussels, and manages around 1.5 billion around in 60 companies. First thing I look at always is the dividend history of a company, even often before the dividend yield. And this is why I'm not so interested, because although it was growing the dividend technically since 2007, so it has had a cut in the great financial crisis. The cut was around, let's say 30-40% at the time, so it was not a full cut. The issue is just as like it was then in 2008 paying a dividend of 236, and it's now paying a dividend of 260. It had 2 times 5 years of a flat dividend. So for me, this is like, I believe it's GSK that has the same, like no dividend growth over all those years. So for me, that's already not attractive enough, because there's no compounding happening here really. So that's why I'm not interested.
Okay, good stuff. Phil has asked, life with dividends. Actually, sorry, Phil, I think I've asked this earlier, but he said he noticed you don't have a single European stock. What is the reason behind that, and what would your first European pick be? I think you gave your reasons, and your first European pick would be ASML, if I'm correct.
That's correct. ASML top on the list.
Top of
You
the
should
list.
just buy one. Just buy. I did the same, because I just wanted ASML. I don't. It's too low yield for me, but I feel like I just need to have one, just one, just
Yeah,
to nurture that.
I think I agree. Yeah, you never know. I might just pull the trigger.
And then Phil's second question, it's the standard question, and it is, could you rank these in the following of importance? So revenue, earnings, cash flow, dividends.
Oh, interesting. Okay. I would prioritize cash flows above revenues, above earnings. And I can't believe I'm saying this, but dividends would be last. But it follows that if cash flows are believable and look good, then your dividend safety is a little more guaranteed. But the reverse isn't necessarily true. And I would much rather prefer companies that can be straight up honest with me and say that if they can't increase their dividend for a short while because of some turbulent conditions or stuff that's out of their control, just be honest and be upfront about it rather than lie about it, increase their dividend, overextend themselves in the process of paying the dividend, and then come back and then cut it and make me look like a fool, right? Make the investor look like a fool. So yeah.
Yeah, we get this question sometimes, right? For instance, on Twitter, people start sometimes bashing about these dividend investors as such, but often people overlook that we are dividend growth investors, and the growth for me is always where the emphasis is. And dividends can only grow when the fundamentals of the companies are strong and when the cash flow is growing over time. So it's actually not awkward that you first look at revenue, earnings, and free cash flow when people really understand what dividend growth investing is, because a growing dividend is then an after effect, right? Something that we need very strongly. But if the first three are not in order, it's really hard to get the last one.
I would agree.
This has asked us, could you please put ticker symbol WSM through your screeners? It appears on their shortlist for months with good metrics, but they are scared of analysts' advice and its short ratio. I actually put this through my screener. The company name is Williams Sonoma, I think. So they're into retail that sells kitchenware and home furnishings in the US. From a fundamental point of view, in terms of my screener, it looks pretty good, to be fair. Revenues have been growing really well, tripled over the last 10 years. Free cash flow has grown. It got particularly strong in the last 3 or 4 years. Dividends has been growing every year. virtually no debt at all, which I like. All their things add up. From a PE point of view, it looks quite cheap. From a total returns over the last 10 and 5 years, it's good, although this year seems to be pretty beaten up. I think it's minus 35%. My only concern, like fundamentally, it looks fine from a screener point of view. My only concern with a company like this is I don't know the company well enough, but I don't know what their competitive advantage is or what their growth drivers would be. I mean, it seems like a fairly easy to copy business for me. So I don't know, but certainly fundamentally from my initial screener, I would not be put off doing a deep dive into this company. And then the last question of the day is from Jan Raykar, and he's listed a couple of companies. So Novo Nordisk, ASML, Microsoft, Siemens, and Allianz. Which one would you buy at current prices?
I mean, this question pisses me so off because Novo Nordisk, right? Oh, fuck it. I had a buy order at 400, I believe. It got to 405. And where is it now? Is it 700, 800? It was the perfect time. And, I always just put buy orders in and let them trigger because I'm not all day in my broker's app to think about this. But I also don't want to buy just everything just like that. So I use these kinds of buy orders and it just didn't take it. And every time I see Novo Nordisk, it really, really frustrates me because, the ultimate diabetes play. People are really not understanding it. They keep on eating all this junk food, getting fatter over time. People need their stuff, really. So 900 Danish crowns at the moment. Look at this. So for me, I'm not happy with Novo Nordisk, and I just can't buy it. I'm price anchored, but I'm afraid I will never see it back at 400. It's just bloody frustrating. So, and if I would buy one of these, it would be Siemens at the moment.
Yeah, pretty much Siemens for me too. I don't know if it's the question that pissed you off or the fact that you saw Novo Nordisk.
Novo Nordisk, it's a red flag, like a bull to me at the moment.
Yeah, I wasn't expecting that reaction at all. I was kind of going, "Wow."
I think the Kleine Capitalist had something similar with Novo Nordisk, but he might have bought it. He's usually a bit cleverer than I am.
Yeah, very good. That was the last question of the day, which was pretty good. Life with dividends. We sometimes do a stock pick of the week, maybe to put you on the spot a little bit, and not Texas Instruments, as we know that you've spoke about them quite a bit. But if you were to pick one company in your portfolio that you would say is maybe undervalued, or you would recommend people to look at, who would it be?
I can't really pick one from my portfolio because I'm not really happy with the existing valuations. I'm not seeing something that's screaming buy at present. But I did more recently take a look at UNP, which is Union Pacific. Not sure if you've been catching the news here in the States. There was recently activities going on as far as railroad strikes and rail strikes and the government getting involved and all that. And it just kind of re-emphasized this point that a simple strike like that got the government involved to a point where they basically had to admit that if railroads were to go decommissioned for a few weeks, there aren't enough freight trucks or anything else that can easily replace that industry or replace that mode of transportation. And what a big statement as far as moats, right? Because you believe that this is an industry that's dying and that's not going to grow, and yet you still don't have, an alternative mode of transportation or something like that. And if you look at the dividend growth history for UNP, you'll be surprised at how much of a resilient industry this has been and what a fantastic dividend growth payer this has been. And I know you guys brought up, I think it was Canadian Pacific or some other railroad companies in the past. It's a misunderstood industry in my mind. And it's something that I'll take a look at a little more closely if the price is right.
The problem is the price is never seems to it just never seems to be right for the reasons that you've just given. It is, I mean, they do really have a pretty decent moat, but I think it's well known that they do have a monopoly in that area, and that's why the prices are always so high. Canadian Pacific is one that I like, but they've always just seemed so expensive because of that, and that's why it's so hard to invest.
But don't they have a 17% compounded annual dividend growth over the last 20 years and 11% in the last year?
Yeah.
I mean, talk about again like a moat, yeah. And the moat is just a single railway here, probably. I mean, yeah, wonderful
you're
business.
right. I was actually taking a look at the CAGR, 5-year CAGR. It's 15.43, a starting yield of 2.41, and 15 years of continuous dividend growth. For something that's a railroad, how can these guys churn out that kind of cash?
Yes, and railroads in Europe, they are always asking the government for money because the tenders that they are doing here, they're usually at the brink of bankruptcy. So something is really a good business there in the States.
Right.
Nice.
Right.
Yeah, awesome pick. It's a new one. I know we spoke different railroads, but it's always nice to hear new companies and putting them back on my radar, because, like you said, those type of numbers, those type of returns are definitely something we should not ignore as dividend growth investors. But hey, listen, thanks a million, Life with Dividends. It's been a pleasure having you on the show. Really enjoyed chatting to you and getting to know a little bit about your journey and your story, and even some of the cultural differences that you had to overcome and where you are in your journey now. So thanks very much for coming on and sharing that with us.
Oh, thank you so much. This has been a pleasure. It's nice to actually get on the pod as opposed to listening every week while cutting grass or whatnot. And yeah, it's been fun, guys. Thank you so much.
Thank you. And we will also put the link to your blog in the description of this podcast that people can check it out. Highly recommended from my point of view. And yeah, hopefully see you maybe one time in the future again back here.
Oh, absolutely. You should do this again. It's a lot of fun.
Super. Good.
Oh, okay. We'll see everybody else next week.